Okay, greetings and welcome everyone to Stifel's webinar on the Russia-Ukraine crisis. We're very pleased to be with you today. And it's an unfortunate topic, but happy to come to you and share some insights as things are unfolding. I want to first introduce my colleagues before we jump into the meat of the discussion. First, Lindsey Piegza, Stifel's Chief Economist. Lindsey, welcome. And then Brian Gardner, Stifel's Chief Washington Policy Strategist. So we'll be coming at this from three directions, where we want to obviously get into what's happening, number one. Number two, maybe get a feel from Brian as to how the administration and our government sort of participating in the response to Russia. And then, of course, with Lindsey, we'll get into the economic implications and then wrap all that up into sort of thoughts about the markets. So with that, let me start though with a little bit of history. I don't know about our viewers, but in some ways, you know, when all this started to unfold, we realized we better try to understand better who the Ukraine is, who Ukraine is, and what the history is as it relates to Russia. So I've had the team pull a little bit, and I just want to pull from a few thoughts there. The first is just to look at the history. If we go way back, basically Ukraine was a part of the USSR, and historically you can almost think of it as two regions, the South and East being sympathetic and sort of aligned with Russia, and then the North and West region wanting to be more independent and Western leaning. And it wasn't until 2004 when basically, there was an overthrow of the government and it shifted to more of a Western friendly government. And following that, then in 2008, you know, so what's that, 14 years ago, NATO basically at the NATO summit signaled, hey, someday we want to bring Ukraine into eventually becoming a member of NATO. And then it was just June of last year that NATO reiterated that commitment. Now, along the way, Putin has been sort of signaling that he's not really happy about that. And it was actually September of last year that they started deploying troops around Ukraine. And then people would say, basically waiting till the Olympics were over to actually invade. And so obviously this, in some ways, has been building, but in some ways, has gone on and happened very quickly. And, you know, really what it comes down to then is there a sort of a part of Ukraine that really wants to be affiliated with Russia? And then what about the part that wants to be affiliated with Western countries and with NATO? So we're 5 days or so into this war, if you will. And so far, it has been limited to Ukraine and Russia, sort of in military conflict, with the West and NATO sort of weighing in more with sanctions as sort of a first step to response. Now, I also would say, as we get started here, if you were to read about this, one of the terms that's sort of back in the media is the idea of the fog of war. You don't really know where things are going. And so one of the practices that we use a lot that really applies here is the idea of thinking in terms of scenarios. So as the work has unfolded here at Stifel, certainly within my group, we've sort of just framed out three scenarios that I'll briefly mention. The first being a bear scenario, sort of the most unfortunate one, would be especially, let's say, NATO engaging in a military way, basically launching an offensive to protect Ukraine. I think the markets are very nervous about the potential for sort of Western allies, NATO, stepping in and becoming active in a military sense. On the flip side of that is the bull scenario, the idea that, you know what, Putin has made his statement, and we get quickly to discussions and negotiations and a resolution, and that happens super quickly. And that's a bull scenario in the sense that I think people in the markets would respond well to that. The middle of the road is not so fast, but we make our way along, right? There's still uncertainty as to whether NATO might engage, and it takes a while for us to figure out where we're going to go from here. the middle of the road. And I would say the probabilities are leaning maybe a little bit more towards that. There's still a bit of uncertainty. And so anyway, that's a little bit of framing of the history, and then some scenarios to think about. I think maybe to start, Brian, let's turn to you. And you obviously are immersed in all things Washington, and the administration having to step up and really formulate a response here quickly has been super important. But it would be great if you could essentially start with your views on our response, and in the moment almost, where do you see things, and where do you see things going?
Sure. Thanks, Michael. Thank you for having me on today. It's not an enjoyable topic to get on and talk about because obviously a lot of people in Eastern Europe suffering, but it also is I think is a chance for us to demonstrate as a firm the depth that we can bring to our clients with your team, Lindsey's expertise and a view from Washington. So thank you for having me on and organizing this. So that, it's interesting because I think the premise that Putin and the Russians brought to this incursion and this invasion was a West and a NATO that was in decline, was in disarray, was disunited. And if anything, it has proven quite the opposite. So sanctions have been more aggressive sooner than I think a lot of people anticipated. And I think that's in large part to the Europeans. I think in some respects, the US is following Europe's lead. And I think that's a little surprising to me because Europe being a diverse collection of nations, it's not always easy to get them on board and to agree to a policy, but they have been quite united. And so it's given the US a little bit more flexibility to let them carry the ball on this. So the economic sanctions so far, mostly directed at the financial system, some of the transportation system. Russia has been cut off. Russian air transportation has been cut off from all of Europe and from Canada. And so that really restricts where they can go. Once you take out the Arctic, Canada was a big part of that. Their access to significant parts of the world is greatly restricted. They have to fly a very long way to get to places. So that should not be underestimated. There, of course, is a carve out for energy. That's kind of the gaping hole in all this, and that will probably evolve over time, depending on the circumstances and how the situation in Ukraine evolves. This morning we had more announcements from the administration here in the U.S. Freezing assets by the Russian central bank here in the U.S. You now have the Swiss participating in economic sanctions, especially in the banking system. That's pretty significant. And here politically in the United States, we're actually going to see a competition between the two parties, similar to what we've been seeing regarding China. Who can be tougher on Russia? So I do think there can be more sanctions coming out of the U.S., but when I look at what Republicans have been proposing a couple of weeks ago before the invasion, a lot of what they were proposing has been accomplished sanction-wise. And that's, again, because I think the Europeans were far more out in front of sanctions than people had anticipated. Next up is probably more in terms of military aid for Ukraine and Ukraine's neighbors to bolster their defenses in case this spills over from Ukraine.
So we'll get to kind of the competition between the parties and whatnot in a moment further. But before we turn to the economic impact with Lindsey, let's tease out a little bit this idea of military engagement. And it's really a check-in with you. Given the dynamic, the political dynamic in the US, what do you see as Washington's and maybe by extension NATO's appetite for actually engaging militarily?
I think in terms of actual troop dedication in Ukraine, I think it's quite low. I mean, Ukraine has asked for a no-fly zone. in the country. And NATO and the US has rebuffed that. They recognize that's an escalation that would put NATO and US troops in direct contact with Russian troops. And that's not desirable at this point. Ukraine, despite attempts to enter NATO, is not a member, and so Article 5 does not come into play. So getting in direct contact with Russian troops is not something that the West is looking for. So I think what we've started to see and will continue to see is increased supplying of Ukrainian defense forces. You're going to see increased military budgets. The announcement by Germany this weekend was actually quite stunning. I mean, just not to go off on a tangent about this, but this is something that Donald Trump had been looking for his entire presidency, couldn't get it, but this changes the resolve of Germans, and whether that's a good thing or not, I've never thought it was a good idea to push Germany to increase its military budgets. It doesn't usually end well. I don't mind a demilitarized Germany, even though they have a commitment to NATO. That's an aside that that's a discussion for another day. But I think, getting back to your central question, NATO, US troops in Ukraine, NATO direct military involvement, I think the odds of that, given the circumstances today, obviously things can change, but the appetite is very, very low. Yeah,
you hear a lot the idea of a wide range of possible outcomes here and scenarios, so that's helpful. So Lindsey, let's turn to the economic considerations and think of it this way. Later we'll think of it as medium to long term. I think let's start though with kind of the immediate circumstance. What do we see as the immediate impact of US GDP, maybe non-US GDP, especially Europe, and then importantly, influence on Fed policy, if at all?
Well, thank you, Michael. I certainly echo Brian's comments. This is a difficult topic, but a necessary topic. So I certainly appreciate you hosting this webinar and the invitation to participate today. Now, I think the central question is, where is the largest impact? How are we going to feel this, both in the US and over in our developed counterparts? And I think, as you would imagine, the largest, most direct impact of the crisis stems from the disruptions and potential disruptions to the global energy market. Russia stands right now as the second largest natural gas producer and the world's third largest oil producer. But we have to put that nominal production level into perspective. Russia provides Europe a quarter of the bloc's crude and 40% of its natural gas. And for Germany, the largest economy in the bloc, Russia accounts for over 50% of its natural gas needs. So there is understandably a growing fear, not just at home, but across the developed world, fears of an energy crisis, fears of a cascading effect, specifically on Germany's manufacturing economy, as we're still reeling from the impact of COVID, attempting to get the global recovery back on firmer footing. Now, for the US directly, Russia does play a much smaller role. Even if we talk about domestic energy production off about 10, 12% since a peak back in 2020, Russian crude accounts for only about 3 to maybe up to 8% of US crude oil imports, and just about 1% of total crude oil processed by US refineries. Now, that's not to say that this is completely inconsequential. Russian crude imports are certainly important to refineries on both coasts, on the West Coast and the Gulf Coast. But on a relative basis, when we're talking about who's going to take the bigger hit, Europe certainly has a larger reliance on Russia's energy production. So piggybacking off of what Brian said, this really creates a devastating predicament where more sizable penalties or retaliatory sanctions that include that missing component, as Brian mentioned, the energy sector, certainly could hurt Russia, but it would likely hurt Russia as much as it does us or those imposing the punishment. Now, we've already seen crude prices up over $100 a barrel for the first time since 2014. And of course, as the conflict continues, that puts upward pressure on prices. For the US, specifically for the US consumer, what's the fastest way to derail the US consumer? It's energy prices, sustained, heightened energy prices. As we know, utilities, gasoline consumption, this becomes, well, has become an increasingly larger component of the household balance sheet. So in and of itself, a backup in energy costs could really serve to undermine domestic activity, consumer spending here at home. But this time around, with the consumer already reeling from elevated costs, not only at the pump, but across nearly every sector of the economy, a further rise in energy costs as a result of international conflict will have, could have an exponentially negative effect on consumers. Now, keep in mind that inflationary pressures that we've already seen in the economy, predominantly stemming from supply side constraints, have been somewhat offset by rising wages and, of course, earlier programs from government stimulus, pandemic-related spending measures. But as fiscal support wanes and spending dwindles, with real wages still trending negative, the consumer becomes, I think, increasingly fragile and then less able to withstand any additional pressure stemming from the overseas conflict.
So with that, then let's turn to the Fed. On the minds of everyone, pre-crisis here was Fed hiking rates, markets saying 6 times. And I think often when a geopolitical event like this happens, they'll pause. They'll sort of say, "Oh, wait a minute, let's wait." The markets are saying no. The Fed's going to keep going. So, what are your thoughts on that?
Well, as many of you might be aware, we were already in, I don't want to say a more pessimistic camp, but maybe a more realistic camp of a more controlled removal of accommodation. So to us, the scenario of 6, 7, 8 rate hikes in the next 12 months, I really viewed this as an increasingly unlikely scenario, even before the latest conflict overseas. But certainly, as you said, Michael, geopolitical strife acts as yet another factor likely to limit the need or justification for a more aggressive reversal of policy. At this point, with a, well, let me start here. With the completion of the committee's asset purchase program, the Fed is very much poised to raise rates a quarter point next month. But the pathway of subsequent rate hikes will very much depend on the evolution of the data. So this is far a predetermined pathway. The Fed is going to be watching the underlying growth rates and, of course, the trajectory of inflation. Now, while prices, as I mentioned earlier, remain elevated across nearly every sector of the economy, in some cases up double digits or at 4 decades high, the committee is convinced that we are at or near peak levels of price growth. So as a result, Fed officials are already anticipating relief from inflation in the form of a second derivative decline or a slower pace of still positive price increases to set in by the second quarter, or and even more as we move into next year, 2023. Now, that being said, cooling price pressures won't eliminate the need for the Fed to remove crisis levels policies or a crisis level of rates, but it will eliminate the need for faster, more aggressive Fed action, with slowing inflation essentially doing a good part of the work for the committee. Now, of course, as you posed it, the question remains, how does Russia play into this? What if energy prices rise even more as a result of the invasion or other costs increase because of further dislocation in the global market? Won't that then slow the expected process and progress of more benign inflation coming down the pipeline, and then in turn force the Fed to act more aggressively, act with more rate hikes, not less, as I would argue? Now, certainly I would agree that either of these scenarios could extend the timeline for the expected relief in current price pressures. A backup in costs or a further prolonged level of elevated costs as a result of an oil supply shock or additional supply chain disruptions, however, will not or should not prompt additional Fed action. Because remember, not all inflation is equal. Monetary policy is essentially designed to address price pressures from the demand side. So if you think about it, why does the Fed raise rates? The committee raises rates to slow consumption and by extension then the overall economy. And as a result, then inflation slows. So think of too many dollars chasing too few goods. But rising rates, increasing the cost of capital, this does nothing to alleviate price pressures stemming from an oil price shock or supply chain limitations resulting from COVID policy or be that international conflict. And in fact, if the Fed raises rates too soon, too fast under these conditions, consumers will still face higher costs because, again, rising rates has not improved supply chain conditions or alleviated supply chain limitations in any way. But now consumers are forced to also contend with the effects of a slowing economy. So this is the argument for the Fed to remain controlled and patient in its removal of accommodation. And the same argument holds, and in fact, I would argue is emboldened under the scenario of international war. And I want to be clear, the Fed is very aware of these policy limitations. The notion that monetary policy can essentially only tackle certain types of inflationary pressures in the economy. And the Fed would not intentionally choke off growth or tighten the economy into recession or inadvertently flatten the yield curve if longer term rates remain restrained by the prospect of more modest domestic growth, 2% growth. So investors seem somewhat aware of this uncertainty, but as you mentioned, they're not entirely convinced just yet that the Fed will take that more cautious approach to policy.
Yeah, maybe a little bit of recency bias, right? It's like they're going to act now, they're going to act again, but they are so forceful in their communication about being data dependent. So kind of to your point, things kind of calm down, they won't have to act quite as quickly. Hey, Brian, I want to turn back to you, but I want to make a comment to our viewers. I meant to do this at the beginning. We won't really take the time today we're already getting a lot of questions in the Q&A box on Zoom. We aren't going to take the time today to directly answer every question, but I'll try to keep an eye on them and sort of guide the discussion accordingly. But I actually encourage people to post questions. What we're going to do in the wake of this is a special publication. Think of it as the most frequently asked questions that we're getting, where we'll publish something that will provide a written response. So feel free to continue to add questions to the Q&A box. Anyway, Brian, turning back to you, I guess I want to start with and this did come up in the box, the sort of the nuclear announcement from Putin and kind of I can say the market's reaction for sure, that they went on a little bit more sort of an alert status, but interested in your view on how, again, the administration thinks about that, responded to that, and are our politicians as nervous as the market seemed to be earlier overnight?
I think the answer to the last part of the question is yes, they are, because for a couple of reasons. One is Putin wasn't honest when he said months ago that he wasn't going to go in, but he has been signaling more recently that he would go in, and I think you have to. So I think the default is you take him seriously. Mm-hmm. And there are observers on the international scene who are far more adept who have a longer history of observing him and his behavior than any of us. And when I listen to them, they are disturbed by what they're hearing. They think this is, they notice a personality change. And I'm not going to get into his mind or try and diagnose him from this far away. I'm far from capable of doing that. But in terms of, are policymakers in the U.S. worried? Should they be worried? I think the answers to both of those questions are yes.
Yeah, it's something I think everybody's watching very carefully.
Yeah.
The other topic I wanted to come back to you on is China.
Mhm.
And, we have a complicated relationship with China. China is an ally of Russia. So they, I think, are stepping in maybe with some financial support. But how do you see China's role in this? And how far do you think it'll go?
So, I think it's interesting the way you put that, Michael, that our relationship with China is complicated, because I think China's relationship with Russia is complicated. A new alliance has evolved over the last couple of years between two countries that have not always been allied, even when they were the dominant Marxist states of the world. They were competitors. China's reaction has been mixed from the reports that I have seen. Their press is covering the story, but in a very fact-based way. It's not leaning one way or the other. So it's not a full-throated endorsement from state media in China of the Russian invasion. At the same time, they're using Russian nomenclature in their reporting. So they're not calling it an invasion. They're not calling it a war. They're using the Putin statement of a special military situation. China has a trading relationship with the Ukraine. It's a big agricultural provider, Ukraine is, for China. So my guess is China's not entirely happy about what's going on for its own economic interests. So I have questions really about what China's what the true reaction is to all this. Undoubtedly they're observing the situation, and for a couple of different reasons. One, like I said, despite the alliance, the two countries have an adversarial relationship, and China's seeing what the West is seeing, which is a Russian military that's not up to expectations. So I think China is observing that part, the military part, very, very closely. I think it's also observing the Western response, going back to my initial answer on sanctions and the Western response to Russia. I think China is observing that, and it's probably seeing a more united West than it would have anticipated. Does this translate into the situation in China that it has with Taiwan? I don't know. There is no NATO counterpart in Asia, in the Pacific, to NATO. There is the Southeast Asia Treaty Organization, SEATO, but it's a far different organization. It doesn't have standing troops. It doesn't have the military alliance and a chain of command like NATO does. So you cannot compare the two situations. But that being said, I think the narrative that the West is not united, it's been in decline, I think that's been refuted. And I think China is definitely taking note as it considers next steps regarding Taiwan and other areas in what it sees as its sphere of influence.
Got it. So I want to switch here in just a second to kind of the medium to long-term outlook. But before we do, just a comment on the market environment in the moment, right? I think one of the things we talked about even at the beginning of the year was increased volatility in 2022. We're coming off of, I guess now we realize in a good way, the Omicron wave kind of peaking and kind of getting behind us, but uncertainties around timing of reopenings and whatnot. Brian, I know you and I have talked about midterm years being more volatile years. We have the midterms kind of looming out there. And then this event basically just adding to almost fuel to that volatility fire. So I think we'll get to our outlook in a moment, which is generally modestly positive, but we recognize we're in a time where a variety of things can lead to moment-to-moment, day-to-day volatility. And we have to sort of be ready for that. in any event, Lindsey, coming back to you, you started to mention some thoughts about sort of the medium term here. We're coming off of really policy support, for example, from the Fed that's been crisis in its orientation. The pandemic, zero level, essentially effectively zero Fed funds rate, the buying of securities, growth of the balance sheet. When you look out over the next 3 to 5 years, talk to us about your views about getting back towards normal, and from your earlier comments, maybe this event, especially if it gets contained, isn't a huge contributor. But just some quick thoughts on the economy over the next 3 to 5 years.
Yeah, I would say at this point, there's still a good amount of optimism in the markets. I think investors are somewhat expecting a swift, if that's the right word, swift resolution to the Russia-Ukraine conflict, and very little, if any, direct U.S. involvement. So for now, it does appear as if investors are more focused on the Fed, the committee's next move, and projections for the pathway of policy throughout the year. So really more broadly discounting the Russian invasion against a year's worth of Fed policy adjustments. But as you mentioned, Michael and Brian, as the situation remains very fluid, investors and market momentum will, of course, develop accordingly. The longer the conflict draws out, the more international involvement, the more likely the conflict will weigh on risk assets and perpetuate a flight to safe havens. But I think what's interesting when we talk about the economic implications, putting just Fed rate hikes aside, I think one of the biggest impacts comes back to the notion of energy dependence or energy independence. At the very least, a lingering dependence on foreign entities to provide energy, a sizable amount of our energy needs, is complicating not only the current scenario, but it more broadly complicates this recent push that we've seen by policy makers, both here and overseas, to decrease the usage of fossil fuels, which has, I think broadly speaking, weakened the Western world, or at least undermined the position of the West, leaving us beholden to other countries whose interests and principles, as we've learned through this conflict, do not necessarily align with our own. Now, President Biden has said that he'll do everything in his power to insulate American consumers from Russian sanctions and the implications of higher energy costs, which I think, and I'll defer to Brian on this, but I think one could argue under a Republican president would translate into a ramp up in domestic energy production. That conclusion, though, is much less certain under the Biden administration. Now, we have seen some reports that particular mines overseas have been allowed to increase output in Wales and Australia, for example. And of course, here at home, we have seen a growing pushback against the White House, instead urging American producers to raise their oil and gas output. But these are really short-term band-aids. As we see with Germany, the decision to phase out nuclear power, plans to discontinue coal power altogether by 2030. And this is sentiment that is echoed elsewhere in the developed world, and certainly here in the US, particularly by the more progressive branch. This has left the economy, the country, the West increasingly vulnerable. And I do think that this is the most important implication, something that has to be addressed and readdressed in the medium and longer term. And this is where we can really say the vast impact on longer run growth in the domestic economy is really going to stem from our recognition of needing to address our energy policies.
Got it. That's very, very interesting. I guess, Brian, turning back to you, I mentioned the midterms, and of course, we have the State of the Union tomorrow night, I think. So be interested in your views on, number one, you alluded to it earlier, but how does this event play into midterms and sort of strategy between the parties? And then anything that we should be watching for in the President's State of the Union tomorrow night?
So, let me start with your question on the midterms and recraft it a little bit, because I think Lindsey really touched on some very key points there. So because we have the midterms coming up, the party's jockeying in Washington to see one who's toughest on Russia, who is most hawkish on defense. And that's a bit of an overstatement, but that's what it comes down to. So I do think we're going to see an increase in US defense spending. We have the annual spending bill still has not been agreed to for the current fiscal year. Those negotiations are coming to a head, but one of the sticking points was parity in the increase in overall spending between defense and non-defense. And this clearly has given some lift to the Republican argument of parity. Democrats were against parity. They wanted more of the increased spending to go to non-defense. Well, I think the Republican argument gets a little bit more support. Republicans will push to reverse some of the Biden administration's energy policies. I think they will be unsuccessful on that because I think Democrats, when they choose what they will give in on, they will give in on increased spending on defense, even by some progressives. I think they'll be okay with that. But climate politics have become such an issue of almost religious devotion among some in some Democratic circles. I think it's really tough for the Biden administration to reverse course on that. I don't think the current situation, as we see it, fundamentally changes the election outcome. Michael, the last time you and I were on one of these back in the beginning of the year, we're kind of forecasting what the year might look like, and I was in the camp of Republicans are going to take the House. That nothing here changes my opinion of that. It reinforces it. I was not sure at that point of the Senate. I'm still not 100% sure, but it seems to me that the map is moving in a Republican direction. And I don't think this changes it. I think domestic politics are going to play more on the midterms than foreign policy, unless something really changes fundamentally from where we are now. So I think we're still looking at a Republican pickup of the House, and increasing, not a guarantee, but increasing odds of a Republican pickup in the Senate. So what for tomorrow night? State of the Union. I suspect that the speech has been rewritten several times in the past week. I suspect it's going to be rewritten a couple more times between now and tomorrow night. By necessity, foreign policy will be the focal point. It has to be. Now, I think the president will try and shift, because behind that, he wants to portray, even before the Russia situation, he wanted to portray an image of normality. The end, transitioning from pandemic to endemic and COVID, there will be no masks mandatory in the chamber tomorrow night, which is a big shift. So normality is a big target. Getting into some of the topics that Lindsey's addressed on the economy and inflation, I think he's going to try and deflect blame. He's going to blame increased prices to a large measure on COVID-induced supply chain disruptions. And I think he's going to lay down a marker for the private sector as well. He's called out some areas of the private sector, energy, ag. I think he's going to do that again in an effort to kind of inoculate himself from any blame for price increases. And then lastly, he might talk about Build Back Better and trying to revive it. And this is kind of the part of the speech I'm going to be watching particularly closely, with the caveat, I think Build Back Better is almost dead anyway. And between Russia, the Supreme Court nomination that's coming up, it's just sucking all the oxygen out of the room in Congress. And so there's no bandwidth left, mixing my metaphors here, but there's no bandwidth left for Congress to consider Build Back Better. But if he buries Build Back Better in a part of the speech, if he only mentions it in passing, well, I think you can take that as a very safe bet that the bill is dead, and the tax increases that you and I have discussed numerous times, I think those are dead for the year.
Got it. Well, it's a lot for us to watch for. Some of the questions that are coming in, not surprisingly, are what are the investment implications for this? So Let me offer a couple of comments. The first is, those of us in the industry, just imagine there's quite a lot being written and published. And a piece that hit my email just about an hour ago sort of went back and profiled different geopolitical sell-offs, basically events. So I'll just mention a few: Cuban Missile Crisis, Iranian hostage crisis, Soviet invasion of Afghanistan, Iraq War, the 2014 Ukraine conflict, and Brexit. Those are some that are on this exhibit. And each of those that I mentioned, there was a sell-off in the equity market, maybe not quite to the level we've seen this year, right? We're down almost 10% on the S&P 500, but think in the 3 to 5% range. In each of those cases, the market's up double digits over the subsequent 12 months. So a lot of times what happens in this kind of environment is there's an understandable kind of risk off, a little bit fear-based reaction. And of course, this is a wide range of possible outcomes. So we do have to keep an eye on things, but the bottom line is the market tends to recover. And so kind of think of it as three things. One is for the long-term investor. We get the question, as you might appreciate, all the time: should I sell my equities? Our resounding answer to that question is no, if you're a long-term investor. The market has proven to make its way back. The second consideration is what I would think of as where do we see leanings in a portfolio? Like if we are putting a little more money to work and we want to take advantage, almost like incrementally, I would say even before this crisis, we've been favoring, think of it as more quality-based investments that are going to benefit from the continued economic recovery and kind of getting past Omicron and the reopening happening. And so that was, quality investments within the sort of value stocks, quality-based value stocks. Think of it as for in terms of the reopening, for those that use active management and a modest overweight to small cap. Those are examples of the kinds of things that we're talking about. In any event, what gets people excited, and I would say, talk to your financial advisor about this, because the moment to moment it changes. But think of it as the kind of the irrational reaction of markets trading, creating opportunity. We have, for example, what we call macro investment ideas, where we'll look at something that we think is just irrationally beaten down. It could be a very focused trade. And so this happens to be an environment, in our view, where there is opportunity. If you kind of know what you're doing and you're hunting around, I don't want to get into the specific product or ideas on this session, but just know that when volatility goes up, that creates opportunity. So especially if somebody has money to put to work, number one, we think it's a reasonable time to be investing. Those greed and fear measures are at the fear side, which is usually a buying signal, but also there will be some dislocation and related opportunities. So again, I encourage you to talk to your financial advisor to dig into some of those details. So hey, I think I had committed setting this up to try to keep it to 30 minutes. We went a little bit over that, but let me take a moment and thank our participants today. Dr. Piegza, Lindsey, thank you so much for joining.
Thank you.
And Brian, as always, just an enjoyable session. You always leave us with lots to think about and talk about. Thanks for joining today.
Michael, thank you for having me. I always appreciate the opportunity.
All right. Thanks, everyone, for joining, and we'll be back soon. Thank you.